What's up everyone? Today I'll be going over everything you need to know to begin investing in a step-by-step manner. It doesn't matter from where in the world you're watching, the same principles and effects will apply, and you, my friend, will most likely get rich as long as you pay attention. In this video, I'll also show you how to get set up in Sweden and what platforms we use here, as well as how much money I have on these different platforms so far. Leave a like, subscribe, and let's go. A couple of quick notes before we dive in. In this video, I'm going to be mentioning a few index funds, mutual funds, stocks, cryptos, all the tools that you'll need to make your money grow and more. But of course, nothing should be interpreted as recommendations or advice. Always do your own research and stay critical when it comes to what you hear on the internet. I've been investing in 15 years with a background in real estate, and I started this channel to help as many people as possible to gradually build up the capital needed to live the life they want. But I'm not a financial advisor. With that out of the way, let's get to it. The first thing we need to talk about is the importance of having a good grasp of your expenses. It might sound a little bit unnecessary, but it's absolutely crucial in the beginning of your career. It's a must to do a little self-reflection before you start pouring money into different assets. I like to think that I have a pretty good grip on what I spend each month, but I still make sure to check up on myself regularly just to make sure. And as long as you don't have unlimited money, you probably should too. A short-term goal that should be top of mind for any investor is cutting out unnecessary expenses, as well as mapping out where your money is going. This will result in more money available for you to invest in yourself in the form of education, businesses, or into the markets. When I was 18, still living at home, I didn't fully realize what a gold mine I was living in. I worked on weekends and had basically zero expenses except for a bus pass and a gym membership. At that time, I didn't track my expenses at all. I just invested whatever was left in my account every month with the bank without thinking too much of what was happening or exactly what assets I or the bank was choosing. And if you can keep your spending habits more or less the same, stay away from that lifestyle inflation, and then try to find ways to earn more money, whether that being in the stock market or out in the regular career world, you'll start seeing some serious magic. If you learn how to invest that overflow of capital, the magic will be even more prominent. And eventually you'll be able to live off of passive income from your investments. And isn't that everyone's dream deep down? If you're aware of your spending, you'll have an enormous advantage entering the world of investing. So starting as early as possible to track what you're getting rid of in terms of capital every month will be a very good habit on your way to your first million, your 18th million, or however many millions you're aiming for. I've personally tried a few different apps and tools, but for me, a good old simple setup in Google Sheets works just fine. That goes for my personal spending and of course also for my businesses. If you have any alternatives to suggest, feel free to drop a comment below. In the process of tracking your expenses, you might realize that you're buying takeout 3 or 4 times a week. Maybe you're eating lunch out with work every day, and that this probably for you too becomes a pretty significant amount of money every year. When you see how you're spending your money every year and you let yourself be guided by that information, you can then of course make better decisions on where you want your money to go in the future, or if you need to make any relevant changes to support your long-term goals. And don't get me wrong, for some people it might make perfect sense to eat out every day. It's basically a time versus money equation, an equation that you're gonna have to solve for yourself. But of course you need to know the different variables in the equation in order to solve it. Is the enjoyment or convenience of spending a lot of money on food every month worth it? Does it free up time for you to make even more money? If so, great. As long as you can afford it and it does not clash with your long-term financial goals. The next important thing we need to discuss before diving into the world of investing is a savings account. Yep. The first thing that you should do when you're of age, be that 18, is to open a savings account at a commercial bank. The specific bank that you choose in the beginning isn't of critical importance, especially not for savings, but ideally you should try to find a bank that offers interest on your money that you have stored at the bank while you're building up your cash buffer, aka cash savings. Make sure that all the money that you have isn't just sitting idle and collecting dust at a bank account. Just put it in an open-ended account that has some kind of interest on it, and you'll earn a couple of extra dollars every year. Good first thing to check off the list. Avanza, which is the most commonly used platform in Sweden, works kind of like Wealthfront or Robinhood in the US, does, at the time of recording, have an open-ended savings account with 2.75% interest. Works perfectly fine. The importance of building a savings buffer has really nothing to do with your age or when you start saving or investing, but it's rather connected to your life situation and future goals, short term that that is. If you live at home and your parents are covering all your housing costs, you naturally have more room to invest the money that you earn. But if you live alone or with somebody else and have shared responsibility over your home, you always need a buffer. This way, you'll never have to sell investments to cover unexpected expenses like repairing your dog. Blink, motherfucker! Or buying a new washing machine. Because if you're unlucky and the timing is off and you all of a sudden need money short term, you might have to sell some of your investments at the worst possible timing and take a loss. And that's obviously something that we would like to avoid as much as possible. How big of a buffer one needs, of course, varies, but I usually recommend at least 2 to 4 months of fixed expenses, whatever that is for you. After you cleaned out all the unnecessary ones, of course. When it comes to which bank offers the best savings account, you can always find up-to-date information by just using ChatGPT. And since this savings account is something that we need for short-term expenses, emergency expenses, we need to look for an account that has no lock-in period, an open-ended account, so you know that you can withdraw the money whenever you need them, even though these accounts usually offer a slightly lower interest rate. And for future reference in this video, the word interest is a bank's way of basically saying return. Perfect. We've now covered budgeting, emergency cash buffer, and a savings account. Before we dive into examples of actual strategies, passive and active, and how to actually get started, let's first address the power of compound interest. That's the power of
compound interest.
An essential concept to understand for any investor, regardless of what markets you're investing in. If you want to use the money you earn to educate yourself, start a business, or in any way boost your entrepreneurial journey or career, I find it hard to see anything negative in that. Quite the opposite. However, the stock market is by far the most common way to reach $1 million, and a really good one too, in my opinion. So let me tell you about the stock market's unique selling point. That is the power of compound interest. It took me about 10 years to understand what this actually was, simply because I didn't really believe in it until I got to experience it firsthand. At first, it's barely noticeable, which makes it even more of a mystery until it appears in the horizon, like a Bugatti filled with ice cream. Let's say you have $5,000 sitting in a bank account. You've been saving for about a year, you've had your first Gary Vee style yard sale, you started your side hustle, your first postgraduate job, you name it. You have $5,000 ready to invest. Let's call this year 0. And then let's assume the coming year you put together a portfolio that has the potential to generate a 10% return year on year. Some years is going to be much higher, some years lower, but on average, that's what your stocks, mutual funds, index funds, and perhaps even crypto will generate you. In year 1, you'll get your 10% return on your $5,000. 10% out of 5,000 is 500. So after the first year, year 0, you have $5,500, right? If we, in this example, just ignore monthly investments, which you'll see are going to play a huge role in how compound interest actually works over time. But for the sake of simplifying this first example, let's stick to a lump sum. You let your $5,500 work for another year. With the same 10% return, your $5,500 will now grow with 10% off of 5,500, which is 550. The return in actual money has increased by $50, even though the percentage return remains the same. All of this happens without you obviously doing anything at all. You're just letting the money sit there passively. And year 2 is now complete, $6,050 in your portfolio. So in these 2 years, you've earned a total return of $1,050. If we fast forward a little bit here to get to the next example, which is a little bit more fun, and look at your account after 10 years. With the same return rate, your $5,000 will now have grown into $12,969. And what is 10% off of $12,969? Well, a lot more than 10% out of 5,000, the original amount that we started with. Note that this entire example is based off of a lump sum, an amount of money into the stock market that you just let sit. You don't do anything. But what happens if you contribute every month? Let's have a look at this free compound interest calculator that I found on nerdwallet.com. We have our initial deposit of $5,000, our estimated rate of return, 10%, compound frequency, monthly, and a contribution amount, meaning how much are you able to put into your investment account monthly. If you make $5,000 a month, you should always be able to invest at least 10% of your income. If not, you need to rewind a little bit and take a look at the private budgeting segment content that we have in this mini course. So let's put in $500 here. After 5 years, your $5,000 lump sum will have grown to $46,945.08. If we increase this number to 10 years, you'll have $150,000 in your account. So let's fast forward a little bit more. What happens after 20 years? $416,324. Fast forward another 10 years. So after 30 years of contributing $500 into your portfolio, you'll have $1.2 million in your account. On top of all this, you'll definitely become more experienced in your field of work. If you're interested in retiring early, you'll probably find ways to make more money so that you can invest them in your portfolio or in other businesses that will generate interest for you. So this $500 contribution is probably going to rise over time, as will inflation, of course, which we will have to deduct from this sum, since your purchasing power probably is going to drop a little bit every year, but we'll get to that. Let's say that you, over these 30 years, on average, are going to be able to save $1,000 per month. Then you'll have almost $2.4 million in your account. And you'll notice that this initial deposit is going to play less and less of a role compared to the amount that you're able to contribute on a monthly basis. If we put the initial deposit to $1, and let's say we upper the contribution amount to $1,200 per month, we're above 2.7 million. If you can sharpen your skill set in the markets, heck, you might even be able to get 12% or 15% on average each year on a 30-year period. What happens then? With a 15% yearly return on average, you'll have $8.3 million. And out of these $8.3 million, you see the bottom blue line here, that's called the principal. After 30 years, you will have invested $432,000, but the rest, the almost $7.9 million, is pure interest. And that interest has been compounding over time. Hence the parabolic shaped curve that you see in front of you here. Isn't it beautiful? All right, I think you're getting the point by now. The longer you can have your money work for you, the wealthier you will become in the markets. Okay, now we know what we should do, but how do we do it? Let's make a goddamn plan. To get a clear idea on how much money you need to have built up in your portfolio to feel comfortable and satisfied, you can use something called the 4% rule. The purpose of the 4% rule is to have a constant income stream from your portfolio passively every month or every year, while keeping enough of your portfolio still invested in the markets to keep growing. Sounds almost too good to be true, right? Well, let me show you. Let's say you'd want $3,000 per month from your portfolio forever, okay? Money we want US dollars. Perfect. That'll mean that we yearly would need $3,000 times 12, 36,000 US dollars. The 4% rule is that you simply just take this number, $36,000, and divide it by 4% to get the sum needed, okay? Okay. Pretty easy. You get $900,000. I'll explain to you the scientific knowledge behind the 4%, but why 4%? If we were to divide by a bigger percentage, let's say 5% or maybe even 6%, we'll get $600, which is 30% less. Sounds much easier, so why 4%? 4% is a beginner-friendly number to use, not to get ahead of yourself, but this number could very well rise if your skill level do, or if you feel like paying more attention to the markets. Well, but let's say we're conservative in this example, and we're gonna assume that the stock market on average each year gives you 8% interest, because this will connect us to the 4% rule. This, as you now know, means that the interest or return that you'll get from being invested in the market is 8% per year. An 8% annual return on $900,000 means that you can withdraw 4% per year, allocate 2 to 3 points for inflation, and still allow your portfolio to grow with 1 to 2% per year, at least. Because for some years, like 2024, for example, the American stock market, the S&P 500, will outgrow those 8%, the estimated 8% return, by almost 3 times. But other years, lower. The American markets, for example, the S&P 500, typically generates positive interest or positive returns 3 out of 4 years. So 75% of the time. And as you just saw me do, you could very well play around with 5% or 6% or even more if you'd like, because the average return from the markets are higher than 8%. The past 20 years. So I wouldn't blame you. The main principle to understand with the 4% rule is that your invested capital keeps growing even though you're withdrawing whatever you need each month, and you're also taking inflation into account. And what is this inflation thing? Inflation is when the prices of goods and services go up over time, making things more expensive. For example, if a loaf of bread costs you $2 to buy today, but $2.50 next year, that's inflation. It means your money simply buys you less than it used to. So the value of money decreases. Inflation is basically inevitable in an economy that's growing, i.e. it is good for your investments that things get more expensive, as long as it doesn't go up or down for that matter too fast. For the US and Sweden, we try to keep the pace of inflation at a maximum of 2% per year. That's what we want. And that is also why we try to deduct inflation from your returns in the market in the long run to keep up with increasing prices. It will make your purchasing power in the future more realistic. Hence, you deduct inflation from a value in the future and you get the real value, the contrary being the nominal value. Great, now we know how to start calculating our long-term financial target, and it's time to dig into the actual strategies. Fuck you. Let me preface this by mentioning a common denominator amongst people who fail to reach their financial target over time. That is that people tend to simply lose interest in the markets, or they forget to follow through with strategies when attention simply is needed. Life changes for everybody, and making changes to your investing strategies is of course a natural part of the process, and as long as you recognize those changes proactively and don't neglect your plan if it's an active one, things usually work out just fine in the long run. And remember, once again, whatever you might pick, be it an active strategy or a passive one,
she is picking her stop loss and profit range.
Each year basically has a 25% risk of being a turbulent one, meaning it could put your assets into a temporary drawdown. So if you're planning to buy a house in 2026, for example, be careful and make sure to keep that savings account with interest occupied and don't take too much risk in the markets, if any. Now let me show you something passive. 6 years ago, I started investing in a so-called fund robot, or robo-advisor, if you will. And when I did my due diligence back in 2019, I found the Swedish startup Lysa suited me the best. I'm gonna show you exactly how to set up an account there in the end of this video, but my allocation with Lysa is I think over 50% in the US markets. So if you're watching from over there, I hope this gives you some comfort. This platform is probably also very similar to Wealthfront or Robinhood for that matter, if they've opened up an automatic fund robot service yet, not sure. My definition of a passive strategy is that you set up the account once and then essentially never have to think about investing again. Super convenient. You just contribute and grow. Grow, baby, grow. First and foremost, instead of paying various fees as you would if you were to pick mutual funds by hand, this through a bank like Charles Schwab, BOA, I'm sure Robinhood too, I pay a one-time fee per year for all the assets that my fund robot or robo-advisor provides for my portfolio. And that is 0.35% at the time of recording, which is relatively low in Sweden. Fees for mutual funds at Avanza, which is the one and only platform in Sweden, typically range from 0.2% to upwards 3%. And it's always very important to be crucial when it comes to fees. In theory, why should you give money to a fund manager when you can buy the assets or stocks that are inside a mutual fund yourself, or find it in a similar ETF? Secondly, instead of choosing funds myself, I select a risk level and a time horizon, and then the robo-advisor selects the funds for me. The assets that I have are very similar to major indices like S&P 500 and the US markets, meaning a large part of Lysa's portfolio resembles my own, the portfolio I have in Avanza that I'll show you in a bit. That's for active duty. But for me, it's perfect because with Lysa, I hedge against my own decisions with my active portfolio. So I'm kind of competing with myself in a pretty healthy way here. Can Lysa's passive fund strategies outperform my active Avanza one? What happens over a longer period of time? We'll see. A robo-advisor would automatically rebalance your portfolio if the market conditions changes. This means that Lysa, as a fund robot, might take profits from shares and mutual funds that they have within their fund robot system and then buy the assets that haven't received as much attention from the market, while you just sit back and relax and watch YouTube videos from Felix Nordqvist, right? This is a set it and forget it type thing, and I'm currently currently sending about 15% of my monthly savings into this fund robot system. So one could say I'm 15% passive. I will show you exactly how to get started on these platforms. But before that, let's go over an example of an active strategy. And if we're going to go down this rabbit hole, we need to talk about stocks, individual stocks that is, and maybe even crypto. Because even though the funds that the robo-advisor invests in contains thousands of stocks, different stocks even, they're bought and sold automatically. In an active strategy, that's your job. You can, of course, also run an active mutual and index fund strategy. And let me give you an example of how that works. Let's say you pick 5 mutual and index funds to begin monthly investing in. And you decide that each fund will represent 20% of your portfolio. For example, these 5 bad boys that I have in my portfolio, they would probably correspond pretty well to these 5 alternatives if you're familiar with the US markets. And by the way, I've had these 5 alternatives in my portfolio for the past 6 years, and they're right on par with the fund robot Lisa. Spending in that olidlig, as we say in Swedish. Let's see what 2025 brings. If you add my crypto and stock selection, I'm definitely in the lead, but enough about me. Some of these index and mutual funds might have negative returns in the first year. I'll take my fingers down now. While others might rocket up like crazy. So after a year, it's pretty likely that some of these assets will have ran far away from their initial 20% allocation. In an active mutual and index fund strategy, you would then sell some shares of the funds that have performed very, very well, and then invest in the ones that have lost from their initial 20% allocation. This is called portfolio rebalance and can be done once every month, every quarter, or every year. Definitely counts as a pretty simple and straightforward active strategy. If you choose funds like the Vanguard 500 or the corresponding Länsförsäkringar Global Index in Sweden, they include classic tech companies like Apple, Microsoft, Tesla, Nvidia, and Meta, for example. So don't think you're ever going to miss out on all the tech hype and fun just because you're choosing an index fund strategy, or a passive strategy for that matter. Is quite the opposite. And on the contrary, if you look at a mutual fund like Plus Fastigheter Sverige, which contains Castellum, Balder, Sagax, and other well-known players of the Swedish real estate market, you start to realize that it's highly possible to put together a well-structured fund portfolio that covers the entire market of interesting individual stocks, if that makes sense. Or, still being in the active category, you could mix it, having a solid base of long-term mutual and index funds, and then spicing it up with a few hand-picked stocks or active strategies like the magic formula. I think this is a great way to start. You have about 5 to 7 index and mutual funds in your portfolio, with or without the robo-advisor, and then you top up with 5 to 10 individual stocks, or maybe even some crypto. And of course, if you're a complete beginner, but you feel like you want to start dipping your toe into an individual stock picking strategy, start by analyzing it, possibly eventually adding the large tech corporations into your portfolio. Some big consumer and goods and healthcare usual suspects, and maybe a real estate trust. I always like to have a solid foundation of mutual and index funds, and that way I make sure that I'm getting exposure to companies in various sizes across different regions of the world and in different sectors. I'm, in other words, very well diversified. I'm a big fan of Spiltan Global Fond Investmentbolag, for example. It's a mutual fund that focuses on investment companies and finance. I also always on a monthly basis try to contribute to an emerging markets fund. In my case, it's Avanza's emerging markets fund. In that way, I'll be exposed to India, Japan, Taiwan, China, South America, the whole globe. Check. Important to know is that a self-assembled portfolio, regardless of what it contains, can absolutely be considered a high-risk portfolio, because risk comes from not knowing what you're doing. Even the fund managers that claim to know what they're doing, in most cases fail to outperform the market, especially in the long run. How can I say such thing? Well, funds that follow a specific index, aka index funds, over a longer period of 10 to 20 years outperforms approximately 99% of all actively managed funds. To mitigate the risk of failing the market, you gotta be the 1%. You gotta beat the odds. So if you want to attack an active strategy, make sure to learn fundamental analysis, preferably technical analysis as well. Give this video a like and maybe I'll do a part 2. Okay, now that we have an example portfolio, a complete passive one, I guess you can say a mixed one and an active one, how much should we invest? Well, if you don't have any other businesses that require capital, you've built up your emergency fund, and you're out of short-term spending musts, well, invest as much as you can. Out of your monthly income, that is. Do you have a lump sum sitting at a bank account and wondering, should I invest it all at once? In that case, if it makes you sleep better at night, it might make sense to spread out your investments over a few months or years to reduce the risk a bit. If you're active, well, you can buy stocks and crypto on a monthly basis as well. The dollar cost averaging or accumulation of assets is a very good strategy. Absolutely nothing wrong with that. No reason to be in a hurry either. It's of course up to you if you decide to apply the famous quote, time in the market beats timing the market. As I said in the beginning, I think you should apply a tactic that allows you to sleep well at night. If you don't, it's probably because you haven't reached the level of knowledge needed for your current strategy. Before we go over the two different platforms, let's talk a little bit about tax. And taxation, of course, differs significantly across the globe. In the US, you normally have capital gains tax in between, I think, 10 to 30% of all your profits. But you also have deferred tax alternatives like Roth IRA that you, by the way, can contribute $7,500 to each year without having to pay any tax on it. But you can't touch the money until you're 60. ISAs in the UK work in a similar way. If you're unsure about the rules that apply in your country, consult with a professional. Maybe ChatGPT will do the trick for you. In Sweden, we have something very non-Swedish. It's called an investment savings account, or ISK. And the tax rate on an ISK that I have most of my investments in is calculated as 1 plus the government borrowing rate. And this ISK tax usually end up being somewhere in between 1.25% to 1.5%. And this tax is applied to your entire portfolio, regardless if you're in a loss a specific year or if you're up. So the obvious downside is you can't deduct any taxes if you're in a loss, which you could do in a normal account in the US or a classic stocks and funds account, aktie- and fondkonto in Sweden, that still exists, by the way, but it's rarely used. The advantages over time, however, are many, as long as you make smart decisions, but that's why you're here. Because basically nothing is required from you when it's time to declare your capital gains. In addition to that, the fact that you pay 1.25% tax on the entire portfolio rather than 30% on your gains, need I say more? Sweden is a crazy place when it comes to taxation on income, but for stocks, oh my god, it's a tax haven. There's also something called a capital insurance, a KF in short in Sweden, kapitalförsäkring. This is a great solution if you have individual foreign dividend stocks. Well, I'm going to show you this when we have a look at Avanza in just a second, but the reason you'd want to put dividend stocks from other countries in a KF is to avoid being taxed twice. Other than that, it works in the same way as an ISK. Let's have a look at Lysa. Okay, I'm now logged into my Lysa account. This is the dashboard. If I scroll down, I press this button right here, Lysa Konto, and except for my own account information, I can see under holdings what type of assets are in my Lysa portfolio right now. And I think this is the most important part, because if you know this, if you know what you have in your fund robot, it's easier for you to decide what stocks or cryptos or funds or mutual funds you like to add into your manual portfolio or your active portfolio. If you want one of those, that is. The biggest stock holdings, Apple, Nvidia, Microsoft, Alphabet, Amazon. These are all the usual suspects found in the S&P 500 index. Scrolling down, we have a few of the Swedish usual suspects that are found in OMX 30, which is the 30 most traded stocks in the Swedish stock market. When you create your Lysa account, you get to decide what allocation you want in your portfolio. As you might have noticed on the dashboard, I have most of my cash savings here in the savings account with a 2.43% variable interest rate. Lysa Konto up almost 90% since inception, which is second half of 2019. This would translate to almost, what, 18% per year? Incredible. When you create an account here, you get to answer a bunch of questions and then you get a suggested allocation. Since my time horizon or investment horizon is 15 years plus, I've decided to take on maximum risk. This basically means that Lysa has my fullest permission to go all in into the stock market. And from what I can see, Lysa has invested in over thousands of shares with my money. So I'm very well diversified here. In here, you can see that I'm currently investing into my ISK from my cash savings account within Lysa. That's what this recurring internal transfer means. And why I'm doing this is because I'm probably not going to buy an apartment next year. I'm probably going to keep renting. So I don't want too much money to just sit here. I also have have transfers from my regular bank account, which is around 2,000 SEK per month, into the ISK in Lysa. I'll leave an affiliate link in the description too if you would like to try and set up an account there. Have at it. And last but not least, let's have a look at Avanza. So I just logged into my account. Avanza has yet to release the English version of their site, but there's always a solution to this. If you're using Chrome, which I think you have to in this case, you simply press the 3 buttons on your top right corner, and then you press Översätt if you're in Sweden, which means translate. You just hit that button, and then you choose by pressing these 3 buttons again. Välj ett annat språk or pick a different language. Hit that and then choose English, and the website translates itself. The important part now is to be able to find assets and to set up a monthly recurring investing plan. What I could do is go straight into monthly savings, and I hit this. Here I can choose what funds I would like to set up a monthly contribution to. So it's literally 3 clicks. When you go in here for the first time, you could just search up whatever funds you'd like to have a look at and then add them to this list. You can hit this search bar up to your right corner. You can search for Bitcoin Valor. And here, just like many other brokerage platforms, you can see the price development for this year, 1 year, 3 years max. And this, by the way, is an ETF, ladies and gentlemen. And if you put an ETF inside of an ISK, it's very nice. It's nice to be able to shop cryptos at 0% capital gains tax, as long as cryptos keep going up or you manage to sell them at a profit, because if not so necessary anymore. I don't know why they named the overview tab just not, but I guess that's what we're going with. Here you simply have an overview of your portfolio. If you click my finances, you'll see all of your different accounts. If you're opening a new one, make sure it's an ISK. Foreign dividend stocks use the KF, the kapitalförsäkring. And there's also a savings account, but that one is slightly better at Lysa at this moment, so that's where I'm going to keep most of my cash. I have some Bitcoin profits up here ready to roll. And under profile, you can make sure to familiarize yourself with different settings. If you go to brokerage class, which is the fee you have to pay to be able to buy shares, most of us will benefit from choosing small. Great, that was a short and brief introduction to the 2 most common platforms in Sweden, at least Avanza is. If you have any questions and concerns, or if you'd like to see a part 2 of this mini course in English, let me know in the comments. Thanks for watching. Ciao.